Hi, everybody. Hey, this is Kenn Renner, real estate broker here in the Central Texas region, and I'm really honored to be interviewing a longtime good friend of mine, Ray Walter, CEO of Capstone Lending, and a bunch of other companies, and his VP of Capital Markets, Christine Bencki. And we're really excited that he's going to be coming out and joining us at the a private wealth event that we're having at the San Jose U.S. Bank building in downtown San Jose on February 20th from 3 to 5 p.m. That's a Friday. It's coming up pretty quickly, Ray. But yeah, we have six amazing speakers. We have a tax strategist. We have the private mortgage banker for U.S. Bank. We have a Silicon Valley real estate expert. We have myself as a Central Texas real estate expert. We also have our CCIM commercial broker that will be flying out from Texas with us. So we have three of us coming out to bring our best A game on being able to help people be able to get the best investments possible, and also strategies on lending as well as tax savings. Being able to these are all things, and then legacy building as we are looking to as we build up our financial portfolios, and then how to protect it when we pass it on to our heirs. So those are kind of some of the things we're going to be covering. Ray is a longtime friend, known him for 40 years, and he started his company. He started working in the lending business back in the 90s, right, Ray? You're
Right.
Michelle and I helped you get a job with Countrywide back in the day. Remember Countrywide, that big name? So tell us how you got started, and then how did that lead you to create these funds that you're using to help our investors prosper?
Yeah, sure. Yeah, thanks to a lot of coaching from you and Michelle. Really appreciate that. Helped me to get in the lending business and got my first, I guess, real job, if you will, in the lending side back in 1998 with Countrywide Home Loans. I was with them for 3 years. Eventually branched out on my own and just did retail lending. Had my own mortgage shop, and about 2005, I started coming across, other transactions would be like, flip transactions, new construction. And it just, the conventional lending platform that I had at the time just did not bode well to help those type of borrowers, right? We just couldn't finance those type of transactions, flipping, type transactions, anything that had a need for private capital. And so I was kind of forced, if you will, to look for other sources, and that's how I became a private lender. And I started realizing that in order to fund these type of transactions that were very unique, that the bank just couldn't get their mind around those type of transactions. I started looking for private capital, and I was doing that in addition to conventional lending. Started raising private capital to fund some of those transactions, and that's kind of organically how I stepped into the private lending world.
So was trust deed lending, after you got out of the conventional world, going to trust
Yes.
deed
Mhm.
lending,
Yes.
trust deed investing, and you were able to help borrowers with higher yields than they would be able to get from the bank, and you were also to be able to provide financing quickly
That's
without
right.
a lot of hassle based on equity of the property and not the borrower, so they could get their project up and running.
That's right.
So yeah, that's amazing. And now Christine's going to tell us a little bit more about the new funds that are coming. The fund that you have that you've just started a few years ago, but you've had the other fund since what, 2019, 2017?
2017, correct.
Okay, so
Um,
yeah.
so t- yes, total assets under management firm-wide are about 120. We recently launched our growth fund, which is our newest fund. That one is about 9 million in AUM and currently returning a bit over 10% on a quarterly basis.
Oh, that's amazing. So, and it's very it's a passive investment, right? And so you that pretty much put your head on the pillow and get your quarterly check. So tell us a little bit more about how you guys operate with that.
Yes, so all of it is, well, 90% of the fund is first liens. We have the ability to transact on second liens, but very small percentage of the fund does so. We transact on both residential as well as commercial space and a multitude of different types of loans. Very simply, we assess the borrower what's called the note rate. We take up to a 2% servicing fee. That's the only fee that's incurred in the fund. And then we pass along the net investment to the investors.
Okay, amazing. So that'd be typical, like from when building from scratch, the builder comes to say, "Will you build the whole project, or is it renovations? What is it, or is it just all the above? Is it commercial? Is it where are we at on the fund?"
It's all the above. We have a preference for single family new construction. I would say on the residential side, we don't really do too many fix and flips or renovation loans. One of our kind of favored asset classes at the present, more so on the commercial side, I would say, is land development deals. We just have a number of just attractive sponsors in the space that come very highly capitalized, low LTVs. So that's something that we're really targeting at the moment, I would say.
Okay, so you bridge the gap between residential or regular commercial or, bank financing, and as opposed to going into a partnership to raise capital, you're the in between, where you be able to help the people to won't have to give up equity of their project. They just have to be able to pay the interest. And so let's talk about a case example of what you had. Let me go ahead and bring up what you gave me, and we can talk about that. Okay. Oh yeah, well we can talk about this because at the point. So tell us a little bit more, Christine, about how this works that we're in your world.
Absolutely. So a lot of our clients on the borrower side, they like to come to a private lender such as Capstone because we are quick. We tend to extend a little bit more leverage and we tend to be a little bit more comfortable with the asset as opposed to just evaluating solely the borrower's creditworthiness. Not to say that we don't look at the creditworthiness of the borrower, but we're really fixated on the asset. At the end of the day, we're an asset-based lender. So borrowers really appreciated us from our quick turnaround time and the lack of essentially bureaucracy and red tape. So we can close the deal probably as quickly as in a week. Some of
Oh,
these transactions on the bank side can go up to 60 days.
okay. And so somebody borrows the money, and like the example that we're going to show here, they borrow the money from you. And what was the loan to value ratio that you lent on?
So it depends on asset class. For residential new construction, we'd be willing to go up to 75%. That's also factored on location. So if you have a strong metro area, we would be willing to extend a max up to 75%. On some of our commercial deals, it can go up to 65%, with land kind of hanging out in 45 to 55% LTV range.
Ah, okay. And so this example, you just funded this one or got paid off on this one. It was a start of 2024, was it when it was first February 2024? Tell us about this project.
So we originate this loan February of 2024. As you can see, it's a new construction single family residence just outside the Austin area. This one had a 69% LTV. We were paid off in full December of last year. The principal basis on this one was $760,000. The borrower did essentially refinance us out of the position going into a conventional note. That will also be kind of typical sometimes if they're looking to hold the property for a longer period of time. They always have traditional financing to refinance us out so that they're incurring a lower interest rate, if you will. But this one
Nice
comes from
house.
the borrower transacted with one of our premier builders. As you can see, there's a keen attention to detail, just very nice finish out. A little bit of a contemporary style house too for a more residential area, but overall they did an excellent job on this one.
Yeah, beautiful house. I did sell a home there last year, this month actually last year for 1.55 million. My financial advisor actually lives in this area down the street. His house is 4 million. So what's the value of this one?
This one's about 1112.
So you paid off they paid 720 off on it. That was 69% loan to value.
So 760 was the principal that was paid
760.
off.
Okay. All
Correct.
right. And the whole idea is then they decided to rent this property out rather than sell it, right?
Right.
Because really, right now the market's a little. It's a great time to buy and build, but it's not the best time to be selling residential property. But I know this area is super solid because actually Ray lives in this area. We sold him the house that he's living in now, and it's in Leander, very attractive to the high tech world. That this Crystal Falls, and also nearby Treviso, which is it used to be called Crystal Falls West. So really big, great schools, great location, and definitely one of the more higher economic demographic that's in this area. I just like to show this $1.1 million house to our Silicon Valley friends who are probably living in a 1,100 square foot house, 3 bedroom, 1 bath, for the same value, right? So this is what you can get if you come out and join us here in Texas. Um,
Uh, and
so give us a, go
another
ahead.
point, Ken, to make too is the refinance via a traditional loan just speaks to the fact that we typically do transact with what we like to call bankable borrowers. So he has the ability essentially to transact with a bank based on his creditworthiness, but for various reasons, in terms of increasing execution time, they might decide to transact with a lender such as ourselves.
So, so you had like Ray, you started doing the trust deed investing first. Um,
Right.
then you built the fund to be more diversified and be able
Mhm.
to spread a risk out over multiple properties.
Right.
And then that was the 2017 fund. Now you've got this new fund that's a growth fund. So let's talk about a little bit different about what the portfolio looks like, and what your goals are with the property, and where do you see the Austin market going?
Yeah, and Christy might have some thoughts on that too, but I'll share this. One, kind of that image that you had up earlier, Ken, where, how we operate between bank and equity.
Yeah.
One of the questions that I wanted to mention this because this is a good segue. One of the questions we get is what borrower is going to pay a higher interest rate, right? And why would they do that? And what happens is when you got banks, that are really getting more conservative. Rates were a little bit higher, right, last year, and so our rates weren't too much higher than theirs, right? But it's dropped a little bit. But when banks are not lending and they have to go get an equity partner, sometimes those borrowers are sharing as much as 50% of their equity, right?
Mhm.
And their profit with an equity partner. And so when they come to a lender like Capstone, yes, our interest rate might be 12%, but it's usually short term, and they'd rather pay 12% than end up giving up half their profit to an investor. So it's a great market to be in. We're seeing much more demand, even recently as banks get more and more conservative. And also the speed of financing, right? On this one, I don't remember exactly how long it took to from start to finish, as far as our underwriting process went, but we have actually closed transactions, believe it or not, as little as 7 days.
That's amazing.
And we can underwrite it. We've got a team that we can all, without compromising the integrity of our underwriting process, right? Just because of our team, we can all come together and get that finalized. We use brokers like yourself, right, to come in
Yeah.
and give us a broker price opinion. Sometimes we get two values, right? If we feel like we need a second opinion, we'll do that as well. But we're seeing a lot more increase in demand, even recently, and which is also, in my opinion, right, a good sign of a changing market for the better. We're seeing, I would say, I don't know if we looked at that, Christine, but the number of applications that we've seen just in the last 3 to 6 months of loan has increased dramatically. And now we sift through a lot. We probably only fund maybe 80% of the applications that come in, and that's even, that might even be a low number, or high number, I should say. But we're it has to make sense, right? There's got to be equity. The borrower's got to have experience. It's got to be location, as they always say in real estate, location, 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 right? You got to have the right location. But we are seeing definitely a high increase of demand in our space. So much so that it's been hard to keep up with it, which is could be a good problem to have. But we're also, kind of like Christy mentioned before, when we first got into this, it started with kind of fix and flip transactions, moved into new construction. Now it's moved into more commercial. And so we kind of have almost an even split, not quite, but almost an even split between commercial and residential in our fund, which further adds, to the diversification that we have for our investors.
That's great. Well, Christine, tell us how it works. Is somebody comes to you and says, "Yeah, I'm interested in investing." What would be like the typical investment level? What would their returns look like? Is there any way to get? Are you in the fund for life? How do you navigate in and out, if at all? Just kind of give us some of those details.
Yeah, great question. So we only transact with accredited investors.
Hmm.
It is a Reg D 506C fund. Our minimum investment is 100,000.
Okay.
It pays out on a quarterly basis, so you can choose to have those distributions received, or you can have them reinvested into the funds. We also accept cash accounts, or you can transact via your 401, or excuse me, your Roth or your traditional IRA account as well. There is an 18-month lockup period. So you're locked up in the fund for 18 months. In order to redeem from your redemption, you just put in a redemption request, and it would be honored on a quarterly basis.
Oh, amazing. Okay. So it's not like some of the, the value add, funds where you're in it for 5 years and you no getting out of it, and hope cross your fingers that the market's going to be in a good place in 5 years. Yours is basically spread out over time. So, and spread out over lots of different properties. And so, yeah, I think that we definitely, especially in residential, we've kind of our market here has hit the bottom of price point, and that gives you guys as lenders a really good advantage because when the market starts accelerating back up, your LTV goes down, down, down. So you have even more protection on the asset.
Mhm.
So yeah, it sounds like a really good. I'm really appreciate your time. Anything you want to add, Ray or Christine?
I think one thing I would probably add, and we lightly touched on this before, but because we're a private lender, just about everything we do is a first lien, right? We're not taking any big chances, any big risk, right?
Yeah.
We do get I think a pretty decent yield, but there's other opportunities out there that if we were in an equity fund, right, might have even greater returns, but there's going to be greater risk with that, right? So we're not trying to take any big risk. It's a mortgage debt fund. A lot of the loans, for the most part, are boring loans, which are good, right?
Yeah.
We don't want anything that's too much drama. But we work with a lot of repeat builders, right? That've been with us a long time on the residential side, and they've been good to us. And we have one builder actually that's cycled in and out of over $10 million worth of transactions with us. Success, we paid them off. So
Well,
so repeat clients are,
Ray, you're truly now a Texas good old boy. So,
yes,
if
that's right.
if people don't know what that is, it means you've been around a long time. You're an OG. I use all these little terms, but the bottom line is
Right.
that we've been going back so many years, decades of working together, helping our
Yeah.
borrowers, helping our buyers navigate things. And one of the things, although you lost a little hair, but I
Right.
didn't lose too much hair, but did go gray during the Great Recession, and you made it through. So anybody that has a fund like this or been in real estate and they made it through and they didn't, without too much ado, that we've really got the experience and also the ways to protect to make the right choices, and that's what
Right.
we're here for, and connect you with the right people, and protect your assets and watch them grow. So we're really excited that you're going to come out to the San Jose area. If
Thank
you
you.
know
Looking
anybody in
forward
the
to it.
San Jose area that would like to attend our meeting next on February 20th, Friday, February 20th, 2026, 3 to 5 p.m. at the US Bank Building, we'd be more than happy to connect you with us. Maybe Christine, you can give us how we can communicate with you guys, how to connect with you, email and phone number, and we'll go from there.
Yes, absolutely. So you can reach out either to Ray or myself. My email address is just Christine, KRYSTINE at capstonefund.com. And Ray's is just Ray at capstonelending.com.
Okay.
And you can reach me directly at 512 386 3150.
Okay, fantastic. Thanks a lot, Ray. We'll get on the plane
Thank
together
you.
and go out there and have some fun, having some amazing food in the California area. Boy, we miss some of that seafood out there. So,
Yes.
um,
Looking forward to
all
it.
right. The way to San Jose. I know that. So we'll see you. We'll see you next week. Talk to you soon.
Thank you, Ken. Mhm.